Hi, this is Zach from Zach's Traders Cafe with a look at the major markets on Wednesday, the 29th of June. Starting off with the FTSE 100 and decent progress for Tuesday, which really revealed what is what as far as the technicals are concerned for this market. 59.50, an uptrend line from February, and we bounced off that on a two-day basis to start the week. The view now is that we should at least head towards 62.50, which is this resistance line from April. An end-of-day close above that should probably be enough on this occasion to take us up to the top of a rising trend channel from December last year, heading as high as 6,600, which is effectively what we were looking at as being the target before the shock Brexit vote. End of day close back below 59.50, the current stop loss on the recovery argument. On to the DAX, and here really we've got back up to the area of former support from March and April, just below 9,500, 94.84, the best level to keep an eye on at the moment. End of day close back above that for Wednesday should be enough to get us back into or confirm that we're back into a range between 9,500 and 10,300, which also would effectively negate this June dip. Interesting that even on the worst times of last week and to start this week, we never really went anywhere close to the floor of this gap from February at 89.67. So failed gap fill, normally a very bullish sign, and that could be what we're looking at the moment. But wait on 9,500 plus on an end of day close basis before getting too excited. Bullish divergence in the RSI window, though, does hint that we are back on the front foot as far as the recovery argument is concerned. Onto the US markets, and 17,331 was neckline support in March. We closed back above that for Tuesday's session, so it looks like a bear trap rebound from both below the 200-day moving average and the old May floor. That should take us back to the range, which is effectively between 17,300 and 18,000 over the last couple of months, and mean that for at least for now, bulls of the Dow can breathe a sigh of relief. Onto the S&P, similar bear trap situation here. The low in May 2025, we closed back above that quite nicely and above the 200-day moving average at 2021, and really while above those two features, we're looking for a recovery of the former range between let's say 2,000, 2,100. The risk was always that if we stayed below 2,000 for any given length of time, there could be a quick loss of another 100 or 150 points, but that has not happened, and this market's starting to look rather more encouraging. Onto the Nasdaq, which has also managed to dig itself out of a hole. Very bearish looking candles for the end of the week, but we had a bear trap rebound from below this falling trend channel from March, normally at 42.50 as the base, and really while above that, we're back in the range between 42.50 and as high as 45 to 4,600. So it looks as though the bulls here have been let off, and really just a one-day shocker or bear trap below 4,200 to scare off the bulls there, but fill the gap there, the second gap down for June, and that is an encouraging sign. On to sterling cable, sterling dollar. Here we've got the situation where after breaking out of that falling trend channel below 136, we overshot down to 131.21. Decent recovery so far, but one would expect resistance to come in towards 135 to 136, and that would be the selling area at this moment, or the shorting area, even if the market or this currency manages to recover after that. But at this stage, sub 130 seems to be relatively unlikely, given how quick any price action below 132 was bought into. For euro dollar, we're holding on relatively steadily. 109, the overshoot figure, was a higher low versus the March support at 108. So technically, we've got a better type of setup here. Probably want to see the 200-day moving average at 110.95 recovered on an end-of-day close, though, before getting too excited that this market has fully negated last week's negative breakdown. Same story as far as dollar yen is concerned. We're looking at the old 103.55 support to be recovered versus 102.73 at the moment. If we can do that, then one would say that the pro below 100 yen was something of a false alarm, and one should be a buyer on dips for this market. But 103.55 still a little bit away, and so one would hopefully see that recovered by the end of Wednesday's session. Just finishing off with gold, which sort of petered out a little bit as far as its breakout was concerned. 1310 to 1320 was expected to be the support area after the spike towards 1360. That old peak for the start of June at 1315. Now the support area. Ideally, one wouldn't see an end-of-day close back below the 10-day average at 1289 ahead of a fresh attempt at upside for this metal. That's it from me. More updates at the same time tomorrow.